Welcome back, everyone, to another definitive A-level business explainer masterclass. We're jumping right in today because we are tackling a massively important topic, AQA topic 3.1.4, financial management. Specifically, we're zooming in on managing finance. We're going to break down those core financial objectives, figure out exactly what drives them, and evaluate how these critical financial decisions literally ripple through an entire business to dictate its long-term competitiveness. So whether you're looking to lock in that foundational knowledge or you're pushing hard for those top-tier evaluation marks, you are in exactly the right place. Let's get started. Here is our agenda for this masterclass. 1. Core financial objectives explained. 2. Prioritizing your financial goals. 3. Influences on financial strategy. 4. Functional links across departments. And finally, 5. Competitiveness and long-term strategy. Let's dive into Section 1. Core financial objectives explained. Right out of the gate, it's absolutely crucial that we distinguish absolute profit from profitability. Profit, well, that's just a raw number. It's simply the final amount a business makes over a specific period after deducting all of its costs, like operating costs, interest, and tax, from its revenue. But profitability is completely different. That is a measure of efficiency. It looks at profit as a return in relation to something else, like your total revenue or the capital you've actually employed, which you often see calculated as ROCE. Think of it this way. A business could make £1 million in profit, right? But if it took £1 billion of capital to generate that million, its profitability is actually pretty poor. Next up, we really need to differentiate between cash flow and liquidity. Remember, profit is recorded the moment a sale is made, regardless of whether the customer has actually handed over the cash yet. But cash flow, that tracks the actual physical money flowing in and out of the bank. It is quite literally the lifeblood of day-to-day operations. Liquidity takes this a step further. It measures the ease with which a business's assets can be converted into cash to pay off its immediate short-term debts. If a business is illiquid, it can't pay its suppliers or its staff. And let me tell you, that is a massive red flag. Finally, we've got gearing. Gearing is essentially a measure of financial risk. It looks at the level of borrowing a business relies on relative to its total capital. So if a business has high levels of borrowing, say through massive bank loans, we say it is highly geared. This means they have much higher fixed interest payments, which definitely increases their vulnerability if market conditions suddenly take a turn for the worse. Now, here is a truly startling fact. Historically, the vast majority of business failures are actually due to cash flow issues, not a lack of profitability. The difference between the two is vital to understand. A business can be incredibly profitable on paper, but still utterly fail and face total closure if it runs out of actual cash to pay its immediate liabilities. Profit is your indicator for long-term viability and success, but cash flow, that is all about sheer daily survival. Moving right along to Section 2, prioritizing your financial goals. So a business's stage of development heavily dictates its financial focus. Think about a brand new startup for a second. Their immediate concern definitely isn't maximizing dividends. It's basic survival. They need to meticulously manage their cash flow just to keep the lights on. Now, contrast that with a mature, established public limited company, or PLC. Their survival is generally pretty secure, so their focus naturally shifts towards maximizing profitability, increasing their return on capital employed, and ensuring strong dividend yields to satisfy those shareholders. And this setup brings us perfectly to our first AO3 analysis task. It's time for you to do some of the heavy lifting. I want you to pause the video now and complete Task 1. Analyze the potential conflict between the financial objective of profit maximization and the need for strong cash flow in a rapidly growing business. Think really carefully about how rapid growth often drains cash balances. It takes a massive amount of upfront investment in inventory and staffing, even if the profit margins on each sale look incredibly healthy. Welcome back. Let's get into Section 3, influences on financial strategy. You see, financial objectives are not set in a vacuum. They're heavily influenced by external factors like current market conditions, economic trends, and crucially, interest rates. For instance, if bank loan rates are sitting around 8%, borrowing becomes really expensive, which directly influences a firm's gearing objectives. But internal factors are just as powerful. The type of ownership and the corporate mission deeply impact strategy. A worker cooperative driven by a social mission is going to set vastly different financial objectives compared to a PLC that's entirely driven by shareholder wealth. Let's anchor these application skills using a really specific context, far more cycles. So they're a specialist independent retailer operating as a worker cooperative. Their core mission is all about providing affordable bicycles and promoting cycling. However, they're currently facing some intense competitive rivalry from massive national chains. To fight back, they're considering a strategic capital expenditure, investing in a brand new inventory management system. Let's put that context straight to work. Pause the video now and complete task 2. Propose one specific financial objective for a specialist independent retailer like Far More Cycles facing increased competitive rivalry, justifying its selection over other financial goals. Remember to root your answer firmly in the context of their worker cooperative structure and that specific external threat from those big national chains. Fantastic. Now for Section 4, Functional Links Across Departments. This step-by-step model reveals the exact AO3 chain of reasoning you are going to need for your exams. Look at how a financial decision creates this massive ripple effect. Step 1. Finance decides to fund a large marketing budget, or maybe they invest in operational automation. Step 2. This immediately increases short-term cash outflows, temporarily worsening the firm's liquidity position. But look closely at Step 3. Because of that investment, long-term sales grow through better marketing, or unit costs fall because of the automation. And that eventually increases overall profit margins and competitiveness. It's like a giant puzzle. It is all connected. And that brings us to Section 5, Competitiveness and Long-Term Strategy. At this high level, you really must weigh long-term strategic investments against immediate financial risks. Let's look back at Far More Cycles. They're considering an inventory system that offers a fantastic 20% average rate of return. That is double their usual 10% target. This capital expenditure clearly drives long-term competitiveness. However, it requires taking out an 8% bank loan and surviving 2 initial years of cash outflows before the investment actually pays off. So, is that long-term 20% return worth the short-term risk to their liquidity and gearing? Well, balancing that is the true essence of business strategy. This brings us to our final high-level challenge. Pause the video now and complete task 3. Evaluate the extent to which maintaining high liquidity is more critical for a firm's long-term competitiveness than achieving high levels of profitability during a period of economic uncertainty. You absolutely must weigh both sides here to unlock those top AO4 marks. Build logical arguments for why cash is king in a crisis, but be sure to balance it against the very real need for profitable returns to actually fund future growth. Welcome back. I really hope you crafted some highly balanced, well-reasoned evaluations there. To wrap up today's explainer, I want to leave you with this final, somewhat provocative thought. We base so many of our business decisions on historic financial reporting, right? Things like profits, ROCE, and cash flow. But these reports completely ignore non-financial factors like staff morale, environmental impact, and brand reputation. So if financial data is inherently limited, can a business ever truly claim its financial strategy is flawlessly aligned with its mission? I want you to think deeply about that as you move into your next strategy lessons. Thank you so much for joining me for this masterclass, and keep pushing for those top marks.